Visualize the world pre-2008, an era of apparent affluence with financial entities dispensing loans with abandon. The economic climate was deceptively favorable. The housing industry was thriving, and desire for ownership was universal. However, a complicated scenario was developing. A housing bubble, inflated by hazardous lending and inadequate regulation, was expanding. Subprime mortgages granted to individuals with poor credit were distributed indiscriminately. They were enticing to lenders due to their high interest rates, but were detonators, with borrowers' repayment capacity questionable. Financial institutions were a perilous operation by converting these risky mortgages into complex investment products called mortgage securities. These were sold globally, with the actual risk often concealed behind financial terminologies and convoluted regulation, rather than acting as a supervisor, was practically dormant. The financial sector was essentially unmonitored, facilitating risky practices. This combination of subprime lending, lack of clarity, and limited regulation fostered a volatile economic state. The housing bubble, a fragile structure. But amidst the boom's thrill, the imminent danger was overlooked. The stage was set for a financial disaster, and the fuse was already lit. As the housing market started to crumble, the first domino in a financial line began to wobble. Wall Street descended into chaos as robust banks and institutions neared collapse. Lehman Brothers fell first, signaling no institution was invincible. This was the largest bankruptcy in US history. The collapse was fueled by complex financial instruments like credit default swaps and derivatives, concealed like ticking bombs within the fiscal structure. As these bombs detonated, the global economic system absorbed the blow. The stock market descended into pandemonium, and investments seemed to vanish overnight. From London to Tokyo, markets shook, depicting the interwoven nature of the global economy. As banks ceased lending, the economy began to falter. Businesses and consumers froze, hampering economic momentum. The financial world was in free fall, and there seemed to be no end in sight. This crisis underscored the perils of unregulated risk-taking, leaving an enduring impact on the world's financial topography. Behind the numbers and the financial jargon, real lives were being turned upside down. The 2008 financial crash was more than a banking disaster. It was a life-altering shock for millions. Dreams crumbled, lives disrupted, and victims spanned far beyond Wall Street. Homeowners who sought the American dream were caught in a nightmare instead, as their homes became debt anchors. Foreclosure signs popped up, stark reminders of decayed dreams. Beyond this, job losses surged, turning once bustling workplaces into ghost towns. The crisis impacted everyone, from fresh graduates to seasoned professionals. Businesses, small and big, shut down, unable to survive the market squall. The destruction reverberated globally, ensnaring economies from Europe to Asia, Africa to the Americas, proving our interconnectedness. The human cost of the financial crisis was unprecedented and deeply felt across the globe. It was a period of intense struggle, but, as we'll see in our next segment, it was also a time of resilience and recovery, a testament to the indomitable spirit of humanity. In the face of such a catastrophe, governments worldwide had to act swiftly. The world's economy was on the brink of collapse, necessitating bold measures. Central banks and governments globally initiated major bailout packages, likened to a financial defibrillator, reinvigorating the world's economy. In the US, the Troubled Asset Relief Program, TARP, was launched, infusing billions into the financial system. The UK government nationalised major banks for protection. Financial regulations were tightened for better oversight. In the US, the Dodd-Frank Wall Street Reform and Consumer Protection Act was enacted for tighter financial regulation. The EU implemented similar measures to avoid future financial disasters. Recovery was slow and painful, with high unemployment and shuttered businesses. The crisis was a personal tragedy for many, leaving lasting scars. Gradually, the world began to recover, economies grew, jobs were created, and confidence returned, although unevenly, varying from country to country. A decade later, the echoes of 2008 financial crash still reverberate in our collective memory, reminding us of the fragility of our global financial system and the need for vigilance. As we look back, we must ask ourselves, have we learned from our mistakes? The 2008 financial crisis was a pivotal moment, signaling the need for stronger regulations and oversight. It was a wake-up call, provoking nations to build robust financial structures. Post-crisis, the concept of resilience came into focus. The tough times witnessed the indomitable spirit of people, a testament to human tenacity. Fast forward to today, the possibility of a recession looms. Indicators mimic the 2008 precursors, raising concerns. However, these are risks, not certainties. The focus now is ensuring banking stability. Banks are mandated to maintain higher capital and pass stringent stress tests. Efforts are underway to enhance financial market transparency and promote financial awareness among individuals, helping prevent the repetition of the 2008 crisis. We've learned tough lessons from the past, taken measures to secure our future, but the question remains, are we prepared for the next financial storm?